Good morning and welcome to our first ever Warrants webinar of 2022. Thank you so much for joining us on this Saturday morning and your support for our numerous online webinars over the pandemic in 2020 and 2021. As you can see, we've been working tirelessly day and night on our brand new studio, content and speakers. Today's session is the first of our two parts this week and next week of our Q2 Market Outlook. Today we've got Mr. Kevin Liu, Managing Director of CICC Research, and Ms. Isabelle Zhen. This lady, she's a warrants issuer, spokesperson, and head of retail equity derivative sales at Kenanga Investment Bank Berhad. Now, some house rules. We've got some giveaways that we're gonna have today. We're giving away 5 Garmin watches. I'll tell you how to win those later on. We've got 10 100 ringgit Shopee vouchers. And another thing is, if you have Q&As, just post them on our private Telegram chat and we will compile all of them. Post them on our Telegram channel so everybody can read them at your own leisure. Now, allow me to introduce to you Mr. Kevin Liu, Managing Director of CICC Research. From a top-down strategy approach by incorporating macro and micro variables, he provides investors with investment strategies as well as cross-market sector allocation and recommendations with a focus on Chinese equities, for example, H shares and US ADRs, as well as general global markets. Now, I know all these titles don't really impress us Malaysians, but I do want to let you know that Mr. Kevin Liu, he ranked number 1 for thematic research and number 2 for strategy research of China in 2021 in the Institutional Investors Best Analyst ranking. Without further ado, hello, Mr. Kevin Liu.
Thank you, Isabel. Thank you for having me. Good morning, everyone. Good morning, everyone in Malaysia. My name is Kevin Liu, speaking from Beijing. It's a great honor to have such chance to meet you on the video virtually to give you our latest update and our thoughts on Chinese market and economic condition. I know you probably have a lot of doubts on what is going on in China, the market, the economy, the lockdown, the COVID thing. All kind of things happening together, caused a lot of volatility recently in the Chinese market. Where we stand right now, where we are gonna head into going forward, and more importantly, what does it mean for us for investment opportunity going forward? Is there gonna be a future potential rally to give you more potential upsides? Or there are other risks or events we should watch for. That's for today. I would like to share with you our latest view regarding China for the second quarter, the economic condition, the policy dynamics, the COVID condition, and also the market dynamics. And more importantly, hopefully we can give you some suggestion and recommendation regarding right now on the Chinese equities. So my presentation today is about the latest update regarding Chinese macro and market condition from both the near-term dynamics condition and also long-term trend. Let me start with the near-term updates first. What is really going on here in China? You probably read a lot from the news report, from the market condition, from the market movement. But what is really going on? The market has been rather volatile over the first couple of months in the first quarter. Let's start with the macro condition. We all know that China actually, since the outbreak of pandemic 2.5 years ago, China actually done a good job in containing its COVID condition domestically and be able to recover first actually from the impact of pandemic, impact of the COVID-19 condition. And thanks to that, we actually enjoy a notable rally recovery and also the so-called dividend of supplying products to the world, which transfer into the continuous external surplus to support the RMB, to support the capital inflows, and also support the economic growth. But it's a normal economic cycle. As you can see from my slides, China is first in and also first out. So where we stand right now is a normal economic condition cycle that we are heading first to slow down. So that's happened actually ever since last year. Since the second quarter of last year, China's economy gradually slowed down, gradually, should I use another word, to moderate. So given that backdrop, actually we see increasing policy support starting from July of 2021, starting from the RRR cut in the bank reserve rate to support the economic growth. But that kind of a normal economic circle cannot explain what's happening recently. Recently, to be honest, admittedly, we do see increasing or refresh challenges on growth. And several things actually attributed to that. First, the demand still remain weak, still kind of sluggish, as you can see from the PMI, as you can see from the consumption. One of the key reasons behind the relatively sluggish demand is that the overall growth is trending downward, as I just mentioned about China's economic cycle starting from last year. The second thing, what actually drives the slowdown is about the property market. As you can see from this slide, property market has been in a downturn ever since last year, and also due to the policy's intention, housing is for living but not for speculation, actually try to, and which, by the way, I believe in the long term is a good thing, try to make property market under control rather than make the economy rely heavily too much on that. But that has some cost in near term, which make the overall growth actually, a little bit suffered, especially when the economic growth in the downturn suffered from the downturn of the property market. As you all know, property market still accounts for a majority part of the Chinese economy. It's still a main drag. You can see that from the total sales and also the prices. That's the second reason behind the recent fresh challenges. The third is the policy. So the policy started to step up to support the growth. RRR cut since July 2021, and also by the end of last year, the Central Economic Work Conference, which is one of the most important economic political agenda to set up the growth target, to set up the policy roadmap for the next year, actually stressed very much importance for the growth, what we call like growth stabilization. But unfortunately, due to a lot of reasons, so far in the first quarter, overall the policy efforts on top of the already existing monetary easing is relatively weak and also behind curve, less responsive. So that actually can be seen on the right-hand side of the figure on my slide right now, showing you right now, is about the physical deposit. So you can see the physical deposit actually increased quite notably in the first 2 months. That actually explains the central government, the fiscal expenditure are not increasing. And the fourth reason is some long-term agenda, reform agenda, actually also, just like property market, has some near-term impacts on the growth. For example, the carbon neutral target, the property market I just mentioned about, and also, some regulation perspective pressure on the internet and other spaces. And on top of that, the recent resurgence of the COVID-19, especially in Shanghai, actually has some disturbance on near-term production, on near-term logistics, and near-term consumption. The COVID-19 condition actually surprised a lot of people here, including residents in Shanghai. It's still in the rising trend. So the local government has to step up to put much harsher restriction policy to try to contain the outbreak of COVID-19. And that's at least in the near term, for example, over the past and probably next couple of weeks, still gonna have some impact on what we call like the near-term economic activities and also consumption activity. But I still have a lot of faith in local governments be able to make it under control in the next few weeks. And it is also the trend repeatedly confirmed by overseas experience, which is whenever you impose a very strict lockdown measure, you probably will see the peak of the new confirmed cases in just 2 to 3 weeks. But that still have some near-term impact. And the next reason is the geopolitical tension. The disruption of the supply chain, and also, the capital outflow due to the risk appetite, due to the risk aversion, due to the fear of collateral damage on sanction, you name it. So all those recent, we should say recent unexpected and surprising accidents or regulation pressure or outbreak of COVID-19 actually has fresh pressure on China. And that in return explains why the market reacts quite drastically and also, has a lot of volatility. But what to do next is more important. We already know, what we are going through. It's not just the Chinese market has been experiencing volatility, but look at the global markets. So what is more important, what we can do next, whether we can weather through all those challenges and what to expect. I think right now, Chinese market, Chinese government actually set a very serious growth target around early March during its annual two session. The 5.5 GDP growth target, at least for now, is still a very serious target from the political perspective. But we all know, just as I explained to you, in my earlier presentation, we see those challenges. We see those unexpected challenges even before the policymaker actually set those targets. That actually means, you have those challenges, you have those negative impacts on growth, meaning that you have to do more going forward to be able to meet those targets. Here, I put on all those fiscal expenditure targets set up by the annual two session this year. And we expect next couple of weeks, especially after the COVID-19 condition could be under control in the next few weeks, we could see policymakers shift their focus to introduce more policy support. Because right now, all the focus, at least majority part of the policy focus are still on the COVID-19 condition. But we don't suggest not to underestimate the policy determination to try to meet its goal and try to stabilize the growth. And we still think there are a lot of arrows in quiver. For example, the monetary easing. The State Council meeting held last night actually sent another strong signal from the monetary policy perspective to support economic growth. potentially we probably will see further cuts in interest rate and also triple R rate. The monetary easing is a very useful tool to support the economic growth, to provide easing liquidity condition, to help to ease the burden on those small and medium enterprises which are suffering during the economic downturn and also the outbreak of COVID-19 condition. So it's still a necessary tool to do. But we don't think standing at this point of time is that really top priority for the monetary policy. Because first, the liquidity condition is already very easy. We started to cut triple R ever since July last year. And the liquidity condition is still easy. So, put in other words, what we lack of is not liquidity, is not the funding, it's actually the demand. But maintain an easing liquidity condition is crucial. So we still expect the liquidity condition is going to be on the easing stance. That will make China and the US policy in a very divergent path. And that also makes the China and the US spread actually narrowed notably. And that in return actually also puts some constraint, not entirely all the constraint. I just want to emphasize, it's just a little bit constraint on the capital flows, on the currency. So if you have very narrowing spread, naturally for some investors say, okay, you're going to generate outflows, you're going to generate depreciation pressure on the market, on the currency. But that's not how I see it. Although I believe, liquidity condition is one of the useful tools, and it's not all of it. But let's think another way. As long as the Chinese policymaker, especially the monetary policy authority, try to send signal to continue to introduce easing monetary policy to stabilize the growth, and as long as the growth could be stabilized, that's actually will help to remove the pressure on the RMB depreciation. Even the spread between China and the US spread are pretty narrow. That's not the key. That's actually not the cause. That's actually the results. We should think in another way. So if not for the monetary policy, we should rely on that much, given the already easing liquidity condition and also the narrowing US and China spread. What we should rely on, what we should expect to. I think fiscal policy is still one of the very important too. The fiscal policy expenditure on the infrastructure investment, especially what we call green infrastructure, the new infrastructure, for example, on the high-end manufacturing, is still a potential very important area to receive policy support. And there are a lot of room for fiscal expenditure to increase. Remember that in the first 2 months, the fiscal deposit actually increased quite a lot. There's still a lot of room for central government to leverage up to introduce more policy support, especially on the fiscal front. And besides physical fronts, industrial policy, for example, property market, for example, certain other favorable or supportive policy for consumption could also be an area we could expect going forward to revive the Chinese economy. And we should put that in a higher priority going forward. And that is why, if you notice the recent market development, you will see that long depressed property sector actually rebounds very sharply. That means actually certain investors already started to expect for such policy move going forward, because property market is such important driver for Chinese economy. And if you want to support the economic growth, physical property market are two fronts, two aspects you cannot simply ignore. But all the things I want to highlight is, first, we have those challenges. That's already happened. That already happened. You don't have to deny that. But what is more important, due to those unexpected challenges, we have pressure on growth. But in order to meet the growth target, meaning that if you believe in the policy, if you believe in that is a serious political agenda and a growth target, there will be more policy support. And policy support could be expected more from the fiscal and also some industrial perspective on top of the already existing monetary easing. But some investors could still argue that, okay, yes, we're still going to expect more policy support. We're still going to probably see the Chinese economic growth going to recover, to a certain point of time, to a certain extent. But the external environment has been changing. For example, the Fed already started to hike its benchmark rate in March, and also hint for future rate hike and a quantitative tightening to reduce its balance sheet as soon as this May. So what's going to happen? What's its potential implication for Chinese market? Is it going to cause notable depreciation pressure on the RMB? Is it going to cause notable outflows from Chinese equities? It seems like the common sense or common narrative to say, okay, as long as the Fed started to tighten, emerging markets probably going to suffer. I beg to differ. I don't think it's a way to look into its impacts from the external impact, external policy tightening. It's simply not the key. As you can see from my slide here, give you the different cycle of fast tightening and also the policy and also the market reaction from not just Asia, onshore Asia Chinese market, but also offshore Hong Kong listed H-share market. One of the very interesting things you can see, especially if you look at 2017, the Fed is continue to hike its rate and also do the similar thing as quantitative tightening. But guess what? If you still remember what happened back in 2017, you will know that the US dollar continued to depreciate against RMB, and foreign funds continue to rush into Chinese equities. Why? The key reason behind that is not about Fed, it's about to tighten. It's not about Fed is shrinking its balance sheet. It's all about what we call comparative growth advantages. Back to 2017, Chinese policymakers actually introduced notable policy supports for supply side reform and also for shanty house renovation. So if you look back the growth comparison, China actually led the US and rest of the world notably by its growth. So given that backdrop, as long as the growth could be stabilized, it could entirely offset the tightening of liquidity condition overseas, instead to draw liquidity, to draw foreign funds into the Chinese market. And the rationale is pretty simple behind that, because the money are chasing for high return. Why not? And I think it's not an entirely impossible scenario if we think what is going to happen next. US and European and also developing markets are slowing down with relatively high inflation. That's kind of for sure, or at least in the near term, as far as all the information we gather, we can see is tightening, is slowing down. But China is already led the world, first in, first out, moderate since last year. The only thing we lack of is more policy support to support the growth, to bottom out. So if Chinese policymakers actually step up for more policy support, what could expect next? Chinese growth to gradually pick up, to bottom out, and developed markets, rest of the world is actually moderating. So you see, that's the comparison, that's the narrowing of the growth trend, of the growth gap. And that, in certain point of time, I think could be enough reason to draw more funds into Chinese market and to support the Chinese equities, especially when Chinese equities actually suffer notable volatility to a relatively cheapened valuation. So that's the key logic and rationale behind that. I don't suggest we simply just use the external fast tightening rationale, as a reason to say, okay, we're going to see notable outflows, we're going to see emerging market all going to suffer. All that matters at the end of the day is the growth. As long as your growth is robust enough, is resilient enough, it's not that big deal for external environment, external global liquidity to tighten. But still, you can see from this side. But still, with the growth still under pressure, which in the first quarter, right? On top, together with the regulation, with the geopolitical tension, with the worries of collateral damage on those transaction or whatever, all those things, we do see certain outflow pressure. And that is consistent with what I just said, because we are under pressure for growth. But that does not necessarily mean we continue going to be under growth pressure going forward. So that actually explains why, especially during mid-March, we see certain outflows. And that outflows can be explained by various variables, but from my perspective, all about the root cause is still the growth. You can find a lot of negativities to explain the outflows, but the root cause, as long as the growth is going to be still resilient, we don't think that actually all those external challenges matters. So that's really the macro background and the dynamics, what is happening, what to expect on the policy, and what is the key to look for going forward. Even if we have to adjust our assumption, but what to look for. And let's take a little bit more step further into the equity market, into the earnings. Given such backdrop, we see the A-share and also the offshore listed H-share market going to still deliver a relatively moderate growth this year. Single or high, low teen, double-digit growth. It's going to normalization. It's going to normalize from last year, but whether we're going to see upsides entirely depends on the timing and the magnitude of the policy supports going forward. But the trend is very clear. It's just a matter of time when we're going to see the bottom out of the earnings. But this year, we're still going to see a decent double-digit earnings growth. That's the earnings. And also, we're going to see the convergence, the normalization between upstream and downstream. Because last year, the upstream actually has a notable advantages compared to downstream due to the higher raw material prices, due to their carbon neutral agenda to cause supply premium for those sectors. But this year, we're going to see those gaps to narrow, to normalize. This slide also give you a trend of the earnings. Cost pressure, we see last year has actually increased on downstream sectors. But this year, some of the cost pressure, especially due to the raw material prices, actually moderate to help those downstream sector to recover slightly from its previous trough. But you may argue that the recent outbreak of the COVID-19 condition still gonna have some negative impacts. Yes, I'm not gonna ignore that. But the thing is, if you look at where we stand right now, it's probably the trough, probably the bottom. If the COVID thing quickly faded, and I truly believe so, although the border opening is still a long way to go. What I'm trying to say is a local condition, is a domestic Chinese condition. As long as being under control and together with a policy to introduce more supports, the downstream, catering, restaurants, consumption, although they are still having a lot of challenges, still have a lot of trouble, but you're also going to see notable rebounds as long as we pass the worst case scenario. So that's for the earnings. Overall, the central case scenario, we're going to see a relatively decent single to double digit growth, but the future trends depends on the policy. And also, we're going to see probably the convergence rather than divergence between different part of the sectors. Valuation is a good thing for Chinese. Is on Chinese market side. U.S. market is trading at a very high valuation. So as long as the Fed is continue to tighten, it's still gonna have certain pressure at least on its valuation. But look at Chinese market from various perspective, especially for the offshore Chinese market. It's trading at multi-year low or even historical low. For example, the Hang Seng Chinese Enterprise Index, the Hang Seng Index, it's trading below the overall index. It's trading below 1 times of price to book ratio. And for certain names, the dividend yield are as high as 10% compared to the overall return, what you can get from the other investment. But the dividends are over 10%. So valuation is actually on Chinese market side. But sometimes you need the economy, you need the growth, you need the sentiments, risk appetite to gradually recover. And on top of, together with lower valuation, it will generate actually more upsides. But simply just for valuation itself is not a reason, at least in the early stage, for investor, especially for foreign investor to buy. But give it a little bit time. So we think, valuation could be an advantage, especially after the first quarter's volatility, whenever we see the recovery of risk appetite and also the growth support. Not to mention all those worries regarding regulation, regarding, geopolitical tension. Recently, we see more US and China regulatory cooperation regarding the audits, regarding the access of the audits of US ADRs. It also sent a relatively encouraging signal for potential future cooperation. Just give it time. So valuation is on the Chinese market side. I think, although it still may be a little bit time, but it's no harm you started to look for very cheapened or quality growth names at a relatively lower level to prepare for the future, to prepare for the future opportunity. And what style could actually be, better off given this economic dynamic? Right now, we think the growth are still a better choice for investors because the overall economic growth is slowing down. So investors tend to find quality growth. But when the policy started to step up for more supports, you definitely want to get more exposure for those cyclicals, for example, property market, for example, property sector, all those upstream cyclicals to directly benefiting from the increasing infrastructure investment. But that's not a conflict with the long-term trend, because whenever you want to invest in China, you definitely want the best part of China with quality growth, the part of the growth representing China's long-term trend. And for what kind of sector, we actually have those kind of a scatter plot to give you an idea what we should look for M.S.T.I China, all those sectors. What we call strategy for now, given the still volatile and uncertain market environment, is just one word: certainty. Certainty. Where you get certainty? Cash flows. Where to get cash flows? First, dividend yield, right? Dividend yield is the cash flow, guaranteed cash flow. The over 60 or 70% of dividend payout, and also over 10% of dividend yield is the certain for sure dividend yield. That's the part on this chart on the left corner side of this scatter plot. For example, Chinese bank, telecom provider, select utility, and energy. They all give you over 8, 9, or 10% of dividend yield. The other way to get certainty is cash flow. Is another part of the cash flow. Is the operating cash flow. Is a quality growth, which is on the right top corner. The quality growth actually suffer a lot due to the overall market volatility, but still has a notable growth potential, especially against the backdrop of the recent, still uncertain market environment. So put it together, our strategy, we use one word to describe it. You want to search for certainty, and that strategy is called Dumbbell strategy. It's just a two-part, right? This end of the spectrum and the other end of the spectrum of the sector. So that's our recommendation right now. But of course, as long as we see more policy supports, we probably suggest you to add up more pressure, add up more exposure for the cyclical names. That's going to changing, it's a dynamic process changing along with the developments of the policy and economy. And the other thing I want to point out is that H shares, the AH premium is at a relatively or very high level due to the underperformance of offshore Chinese market, due to its vulnerability to global risk appetite, to US and China regulatory friction or geopolitical tension. But all those will pass or shall pass. So that actually give you much even cheaper valuation compared to A-share market. It's one of the cheapest market right now globally. So H-share market, we suggest you to watch for it. We suggest you look for potential opportunity as well. But we might consolidate a bit until more positives to emerge going forward. But I do want to point out the attractiveness of H-share market. You probably recently noticed a lot of companies actually introduced massive share buybacks in the H-share market in the US ADRs. That actually all give you a signal that even for the corporate money management actually have confidence or at least believe their share value has been undervalued in the market. So that's our recommendation. The Dumbbell strategy, search for certainty, is right now giving recent the economy and market environment what we suggest. Here we also provide certain topic portfolio baskets just for your reference. Is similar strategy and rationale I just described about. So I won't go too much into details about the recommendations. There are another part I don't want to spend too much time, but I do want to highlight a little bit. Last but not least is a long-term trend. A lot of things has happened over the past quarters, months, years. But in order to understand China, in order to find better opportunities in China, you have still to understand, from the long-term perspective, why China is doing this and why we are experiencing this. So the long-term trends are equally, if not more important, are equally important to understand China. So the first China's phase is this growth phase. The dividends, thanks to global trades and also population, already gone. So what we have to do is we try to find another way, most sustainable way to revive, to guarantee for the next decade growth. Apparently, it's not going to be property market. You don't want to rely too much on property market. It's not going to be sustainable. You have to upgrade your manufacturing. You have to find more sustainable way. You have to find more a healthy way to support the growth. So consumption and industrial update. If you think a little bit longer, over the past few years of all those policy efforts and intention, you understand why. And that actually not happened just now. Over the past 10 years, China is trying to reshape or to shift its growth engine, the so-called old and new economy. The new economy, which is the better part, or a kind of a more the part reflecting China's growth potential, actually outperformed the old part substantially over the past 10 years. Yes, we have some regulatory pressure on internet, so that's why you see the underperformance. You have seen a lot of regulatory uncertainties, but that's not going to change the overall trends reflected by the capital market, reflected by China, where China is about to head to. So even you don't want to search for opportunity in the internet space or space with a lot of regulatory pressure, you still need to focus. You still bear in mind what actually you want to get, what you actually want to ride from Chinese growth. Apparently not the old part. So what could be the next new part? Manufacturing upgrades. That's the one way China has to do to support a more sustainable growth going forward. And China has the advantage to do as long as the globalization trend and the global environment still remain relatively healthy and friendly to China. China has the supply chain, has the engineered dividends, has all those tools to help it to achieve this. But we do see the path is not as smoothly as we expected, but we do see policy needs to do that. And the other trend is consumption upgrade. The middle class, the West domestic consumption market, you cannot find anything elsewhere in the world. Look at the new energy vehicles. Why it booms so much in China? That's the only domestic market you can sell so many quantity of new energy vehicle. You cannot get that big market anywhere else. That's just one single example. The smart cell phone, all those parts I listed here is about consumption upgrades. So those are the two trends. And to support the trends, the wealth management, the development of domestic capital markets, and also the deepening reform and the opening of capital markets are vital. And the shift of household assets allocation also going to help to help the Chinese capital market to achieve such goal. We still have a lot of room to go compared to developed markets regarding the capital market development. So that's not a simple trend or near-term setback gonna going to put a stop to that. So we still have a lot of faith in China's long-term growth, although we have a lot of challenges. And the bottom line is we have to bear in mind where we are heading to, and for foreign investors, what you want to get from Chinese economic growth, and the best part of it is probably what you want to get widening Chinese economic growth. And the stock exchanges has been set up, in Beijing as well. Is also one of the policy efforts to support the development of the capital market development. So that is really all I want to share with you today, and I really appreciate your time today. It's a great honor to be able to have the chance to share with you our views regarding China. Two parts of my presentation. The first part is really about the near-term updates on Chinese macro and market condition and our recommendation of the capital markets. The second part is a long-term trend, and which I believe is also equally important. So that is all for my presentation today. Thank you again for your attention.
Thank you so much, Mr. Kevin Liu, for that insightful session on the big picture idea of all the macroeconomic activities affecting the fundamentals of how we actually trade in Malaysia. All these things really do affect our view, and that was a fundamental view first. Next week, we'll have a technical view by our next speaker, Mr. Johan, happening 1 week from now. But right now, we're going to look into structured warrants for Hang Seng and Malaysia. As usual, a very exciting disclaimer on the things which you should read to your heart's content, and a background on Kenanga as well. Today's presenter, you can read all about her later on. She's a warrants issuer, and that's all you need to know. As spoken, we have our Garmin giveaway. We're giving away 5 Garmin watches, and all you need to do is write your 3 key takeaways from today's session, from either Mr. Kevin Liu's session or Miss Isabelle Zhen's session. Share it. This is key. You gotta share this post on Kenanga Group's Facebook over here. Go to Kenanga Group's Facebook, press share, and press your 3 key takeaways. And if you're terribly confused and you've forgotten what to do to win those Garmin watches, join our Telegram channel at Naga Warrants or our private chat at Naga Warrants Team. Let's get to the big question of today. So what? Why am I attending all of these webinars and talks and things from stock market gurus and technical analyst gurus? How does this news affect my financial goals or my portfolio? Another question you need to be asking yourself is, how do these people actually make money? Bankers, fund managers, agents, stock market gurus. The thing I want you to remember from today is you got to question everything, and that includes questioning me as well. Because a speaker's content is as good as you want it to be, right? It's whether you actually listen to them, but you need to actually know whether you're listening to the right person. So question everything, and remember, success when it comes to trading, it's from preparation, meeting, opportunity, and luck. The more you prepare, the luckier you get, the higher your chances of success. And as you can see over here, the right skills, right technical tools like structured warrants and sector, country, and markets come in the form of opportunities. Don't worry if you can't see my slides, I'll send them out on Telegram later on. You can see them sideways. Oh, there we go. Yeah, you can see the slides, don't worry. Personal Finance 101. Now, these are some key concepts which I've learned over the years, and I think they are really helpful if you actually want to, before you even start trading or investing. You kind of need to know these few concepts, and trading and investing only comes after you actually perfect all of these things. The main one that I want you to look into is make sure you are clear with your daily habits. This is more on money management. Daily habits may include your necessities, financial freedom, put a percentage aside, put 6 jars aside. This is T. Harv Eker's financial planning themes. And also, I love this one by Robert Kiyosaki. He tells you a bit more about where your income goes. Income into expenses, or income into liabilities into expenses, or you would ideally like to be having a long-term view, right? A long-term view of buying assets so that they can provide you income. Yeah? Now, this is your secret weapon that we like to share. Your secret weapon would be compounding interest. Now, compounding interest, it works in these ways. Let's say if you put in 10,000 ringgit to start with, and every single month you put in 1,000 ringgit. At the end of 12 years, you only get 144k. How unexciting. 12 times 12, right? But if your return was put into something like a fixed deposit, it will give you about 3%. Right after this, I'm going to show you a product that actually gives you 3% per annum. It's a brand new Kenanga product. I don't have to actually push it, but I think it's useful for you guys. I actually get 0 commission from sharing it. And other things include having an ROI of 8%. This provides 237, 15%, 1 million ringgit actually comes if you get 30% per annum. So the main idea is, how do I make 1 million ringgit in 12 years? And how do I do it faster than that? I've shared these slides before in my 2020 and 2021 webinars, but I realized some of you actually don't really watch my previous webinars. You guys just come in and then don't really do your own research. So I kind of broke it down for you this year. So this is a compound interest calculator, and you can get it online. You just search for compoundinterestcalculator.com. And what this shows is, if you actually put 10,000 ringgit into a product that gives you 30% ROI, return on investment, every single year, this is 30% per annum only over a period of 12 years. And every single month, you invest 1,000 ringgit into it. Compounded, that will be 1 million bucks. So if that doesn't make you pay attention to today's webinar, I don't know what does. If you're not interested in these kind of numbers, then better switch off the webinar straight away, because this webinar just isn't for you. Structured warrants isn't for you. If you're very happy getting lower returns, then this isn't the right way to spend your Saturday morning. So comparatively, 30% per annum, 20% per annum gets you 600 over K. Same principle as well, 10,000 ringgit to start with, 1,000 every single month in whichever product gives you 20%, and 10% per annum gets you only 301k. So what does this tell you? It tells you that just by increasing your ROI slightly from 10% to 30% makes a lot of difference. 300k to 1 million. But let's look at something else. I've realized that a lot of people, they would say things that sound like this. They would say, hey, you know what, Isabelle, I'm really happy to invest my spare cash once I actually have more money, I actually would like to have, maybe once I hit 100k or 50k, then I'll start thinking of what to do. Right? I used to have that impression as well. I thought to myself, hey, you know what is 10,000 bucks? What can 10,000 ringgit do me, right? But let me break down the numbers and prove both of us wrong. So let's say if it's 100,000 ringgit, you started off with, say you saved for a few years and you got to 100,000 ringgit, and you still found a product that pays you 10% ROI. After 12 years, the projection would be 584k only. Let's say you saved up to 50k instead of the 10k initial that we mentioned earlier, right? 50k gets you 427,000 only. So what does this tell us? It tells us that ROI is more important than your starting capital. So even if you have 10,000 ringgit, and don't sweat, even if you have 1,000 ringgit, the main idea is to learn about the different financial products all these banks are offering, all these broking houses, and figure out how these products can benefit you and your own financial goals. All right, don't be suckered into thinking, oh, I need to have 50k, 100k, 200k, 500k before I can do something and open a franchise or something. That's fine, no problem. But if you want to do something, if I could rewind time and I was somebody gave me a bit more guidance, you have to realize that time is your friend, you know? Compounding interest, it works according to time, and it actually jacks up towards the end of your ROI period. So let time and let money work for you. And what you need to do to increase your ROI percentage from, say, 10%, 3% if it's an FD, 8% if it's an ETF, is to just learn about a few other products, and that can improve and be a kicker for your entire portfolio. Is that okay so far? Do you guys get that? Yeah? Alright, if you understand, press OK in the chat. If you don't understand and I've completely confused you, press KO in the chat, okay? I hope to see more OKs than KOs in the next few moments. Alright. So instead of worrying about what you cannot control, set your energy to what you can create and control. You know, don't worry so much about different things that you are beyond your capabilities. So for our first giveaway, question number 1 for the first 100 ringgit Shopee voucher. What are your key takeaways? So actually, there's only one key takeaway from the compound interest calculator I just shared. What is your key takeaway from the compound interest calculator? For the answers that you write, please write Q1 and then your answer so that I know you're answering for Q1. I won't spend too long on this. I'll go through the winners later and I'll announce them on Telegram on Monday. So, what is your key takeaway from the compound interest calculator? I'll give you 5 seconds. 4, 3, 2, 1. Okay. ROI is more important than your initial capital. Easy as that, right? Let's jump into a tiny bit about portfolio management. I promise you I'm going to teach you about warrants, but you need to understand where it fits in your portfolio. I'm not asking you if you have 100k investment capital or 10k investment capital. I'm not saying to put the whole chunk into structured warrants, or I'm telling you how to manage your own portfolio. So let's say if you buy a fixed deposit that gives you 3% per annum, and say that's half your portfolio, right? And say you buy ETFs, 30% of your portfolio goes into it, and the return is 8% per annum. You can see in my whole talk, I'm going to be repeating ROI a lot. Okay, so bear with me. That's the only thing that matters. And if you trade, say, something volatile and exciting like Hang Seng Index warrants, even if you put something like 20k and it gives you a ROI of 50%, it actually jacks up your whole portfolio. So if you want to calculate it out, that's, say, 50% of your portfolio into something that gives you this ROI. 30% of your portfolio gives you this ROI, and say 20% of your portfolio gives you an ROI of this 50%. You actually can increase your whole portfolio's return to 13.9%. I know it's not so sexy just yet, but I'll show you how 50% on HSI can happen in a day or two. All right. So does everybody kind of get this concept of portfolio management? The barbell theory, it really looks at how you can have your large investments, a chunk of your portfolio or available capital, you put them into a product that is less risk, less rewards, and a small part of that investment, you put it into something that is high risk, high rewards, big payoff. Of course, some of you are going to be, hey, Isabelle, why don't I consider putting it into crypto? Fine, do as you please. I'm just giving you the concept. It's up to you how you want to invest in it. For some people, that 10% can be anything. 10% can be risky. 10% of that risky portfolio can be crypto for somebody, forex for somebody, structured warrants for somebody, real estate even. Everything can be risky depending on you. So I don't know your risk preference, but I do hope that you employ this strategy, because if you say put 100%, right? Let's say you put 100% all of your money and you buy something risky, like into this portfolio, 100%. And of course, you're thinking to yourself, oh, all in, guys, it's make it or break it, right? It is really easy to lose a lot of cash. Just to entertain you while you're stretching around, all right, have a read through this little TikTok that I saw the other day. This guy, he says his parents gave him 500K to invest in the stock market, and he lost it all easily, and that's 500K US dollars. So that is why you employ the barbell strategy. So let's say you're not so familiar with trading, put a small percentage aside. Consider that to be your trading or learning portfolio, or as us Malaysians like to call it, we call it our tuition fees, right? Don't put 100% into something that you're not comfortable with. And if you want to diversify your portfolio. 50% here, 30% there, 5% here, 5% there. All right, that's the best thing. So earlier, this is a new product that Kenanga has. Like I said, I don't benefit from it, but I thought you guys might find it useful. They have a new fixed deposit for 3%, which is the highest FD in the market. And of course, you can invest in ETFs through Kenanga Invest. So KDI Save does 3%, which is the highest FD in the market at the moment. I love robo-advisories. I love Stashaway, MyTheo, Wahid Invest. I look at all of them. And as some of you know, they also have a safe portfolio, a fixed deposit kind of protected portfolio. But I do know that this KDI Save, it's higher than those. So just consider it, that's all. And ETFs, usually for the past few years, annualized returns for the S&P 500 have been about 8 to 10%. So if you want something like that, then consider these products. But like I said, 3%, 8%, 3% and 8% is great, but it won't really get you to this baby, right? Oh, yeah? 3% is quite far away from there. But you do need these products to protect your capital as well. You don't want to be trading all of it in case you make mistakes, in case the market goes against you for whatever reason. So that's why we're talking about structured warrants today. Oh, right, next giveaway. Woohoo! I can take a break while you guys think. Which Kenanga product offers 3% per annum? I'll give you 5 seconds to answer. Remember, in your answers, write Q2, so I know you're answering the second question, and write your response, all right? 5, 4, 3, 2, 1. And the answer is KDI Save. Question 3. For that 100 ringgit Shopee voucher, which Kenanga product offers investing via ETFs? 5, 4, 3, 2, 1. And the answer, which I assume you guys know, is KDI Invests. Bravo! You already know how to get 3% and 8% easily ROI, yeah? So how do you actually do something that will jack up your portfolio? You know, the entire weighted portfolio can be increased in ROI. So let's get into warrants. There are 3 things which I'm going to teach you today about structured warrants. That is the M.E.S.T.I strategy, the Mesti strategy. You mesti gunakan Mesti to trade warrants. The second strategy I'm going to teach you is the last defense strategy using the live matrix, which is coming up right now. And the third one, which I'm teaching you, was earlier, that barbell strategy, which teaches you to know where warrants fit into your portfolio. So how to trade, last defense strategy. I got this last defense strategy name from one of our traders. He was 26 years old and he was already handling a portfolio of 4-5 million at that age, and he had no SPM certificates. He had no degree. He was in events before. Alright? So if you're saying that structured warrants are for intellectuals or professionals, yeah, great. But it can also serve anybody. Warrants are your slave, okay? Don't be a slave to warrants. Alright, so let's look at this a little bit closer. So the last defense strategy, it looks at the live matrix by Kenanga. You can find this live matrix on our website at www.com/live matrix. We launched this in 2019. We are the first Malaysian issuer to offer a live matrix. Alright, so the way you use a last defense strategy is you need to understand how the live matrix works. Let's say DNO-CI, underlying bid price, underlying ask price, that means DNO, warrant bid price, that means DNO-CI, and warrant ask price, DNO-CI over here, right? Here's the underlying, here's the underlying. I'll zoom in a bit more so you can see my slides, which is super beautiful and not at all messy. Okay, so let's say DNO-CI, DNO was 5 ringgit 95 at the time and 5.96 on the ask, and the warrant was 35.5, 36. The way you employ the last defense strategy is that you look at the flipping point of the warrant, and each warrant has a different flipping point. So let's say this warrant over here, I can easily see that the amount of ticks it has, which is 1, 2, 3, 4, 1, 2, 3, 1, 2, 3, 1, 2, 3, 4. Forgive my fat pen, but you get the idea. So this warrant, DNO-CI, is 3 to 4 ticks. That means every time the underlying moves 3 to 4 cents, then the warrants will flip one time. Meaning, let's say I picked up DNO over here. I wanted to buy the underlying at 5.96, but instead of that, I look at the warrant. I would pick it up over here at 36 cents if I'm buying the offer, instead of, let's say if I didn't know there was a live matrix, right? If I actually picked up a warrant over here at 36 cents, I would have to wait for DNO to move from 5.93 to 5.94 to 5.95 to 5.96 before it actually breaks even 36 cents, right? Because I picked it up here, 36. So why not I just be a bit smart and I just pick it up here as well when DNO itself is 5.95 instead of 5.93. Right? It's the same thing. Just that I know that immediately the next price when it flips, it'll be 36 cents and I will break even on my investment. So let's say, how do I use it to chart a take profit price? Let's say I foresee DNO at that time was going to go from 5.95 to 6 ringgit 7 cents. So I'll be able to chart, let's say this is the same day, all right? We all know DNO can move 20 cents up and down easily. So I would take profit. I would say, all right, my TP is 37.5 cents over here. And that would happen when DNO hits 6.07. Instead of me having to wait for 608, 609, 6010, I know that it's going to be the same price, 37.5, 37.5. So I will put my take profit price at the lowest range of the live matrix, right? You can see that gray is the same color, white is the same color, gray is the same, gray is the same price, white is the same price, gray is the same price, white is the same price. Similarly, when I do something like a stop loss. So if I'm doing a stop loss, I would do roughly the same concepts, but I'll do it in the opposite direction. So earlier, we're looking at take profit prices being over here, right? The last level, just when it flips to that price, then immediately I'm already saying, all right, 37.5, I'm taking profit. But let's say if I want to prepare a stop loss. And instead of saying, let's say I picked it up here at 36 cents, and I allow myself to have a 1 tick stop loss or a 2 tick stop loss at say 35 cents. And I see a big support for DNO over there, a lot of buyers on the bid, then I know over here would be 35 cents, same price. So why would I exit a position when DNO is 5.92 over here when I can just, buffer a bit, and I know that even if DNO drops down 5.91, 5.90, I can still get out at 35 cents. Are we okay so far? Everybody all right? Everybody still sane? If you are still sane after this slide, press sane in the chat, please. Talk to me. I get really bored talking to myself. If nothing makes sense to you, you can press insane. All right, so DNO, we covered that first one. No problem there, right? No problem. Everybody is sane. Easy peasy. So the difference between all these live matrices, which look very complicated at first, and hopefully I eased it down for you, is that all of them have different ticks. So earlier I mentioned gray zone, white zone. It lets you know how many ticks the warrant has. So just now we looked at this DNO, and we know that easily it is 3 to 4 ticks, right? Here's 4, here's 3, so it's roughly 3 to 4. And we can look at another DNO warrants. We can say, hey, the 2 whites, 2 grays, 2 whites, 2 grays roughly. So we know this guy is about 2 to 3 ticks. And we can employ the same stop loss and take profit strategies that we did just now. And then I go to this one, and hey, wait a second. Why is this one highlighted in red? Right, it's a traffic light concept. Green means, let me show you over here with my beautiful handwriting. Green means good to enter new positions. Amber means orange. That means don't enter a new position, and red also means don't enter a new position. Why is that? It is because of 2 reasons. The issuer has either run out of inventory or running low on inventory, or they just don't want to sell it for any reason. What happens is, instead of say DNO is 5.95, 5.96, right? The bid and ask spread for the underlying DNO is tight. But the derivative warrants, the structured warrants, is supposed to be, say, 162. Here should be 163, right? It should be 163. Why has the issuer done this? It is to dissuade you from trading it. The reason is, when you see it on your trading platform, right, whatever trading platform you use, you can actually buy structured warrants on your whichever brokerage. You don't have to have a Kenanga account, all right? Even though my bosses would like to say get a Kenanga account, okay, but you don't have to get a Kenanga account. least any account that you already have. Structured warrants are listed derivatives, so they're already on the market, so you can use any brokerage account to pick them up. The reason is 162 is on the bid. Oh, I'm mirrored, so let me use this hand. 162 is here, 163 is here, right? So the issuer will maintain the bid price here. But if they don't want to sell it, they will increase the ask to 163, 164, 165. The problem is, if you don't look at the live matrix, there can be other individuals queuing in between these prices, and they can actually buy the warrant up or sell it down to you. So you might enter it at 164, and suddenly the fellow withdraws, and then you're like, hey, why is there only 162 left on the bid? Complicated concept, I know, but that one is more for advanced individuals, all right? If you're a beginner, just close your ears to that last part. Just remember, red means no. Amber also means no, okay? And finally, for DNOHA, this warrant's expired, but never mind, I'll give you the example. DNOHA, H means put. So a put warrant works in the opposite direction of a call warrant. As you can see over here, when a call warrant goes up, the underlying goes up in price from 580 all the way to 609. The warrant as well goes from 156, goes up to 167. This is a very expensive warrant, that's why issuer is not keen to sell anymore. But let's say if it's a put warrant, it lets you benefit from DNO underlying coming down. So if you actually foresee it maybe hitting a really hard resistance and it's going to be retracing shortly, consider a put warrant. What happens is, let's say 609 comes down all the way here. You can see that the warrant actually increases in price. So that's how you benefit from a put warrant. So have I covered everything that I wanted to on this slide? Oh, a tiny bit more. So let's say I actually entered a green color warrant, right? Isabelle, you told me green color warrant is fine, then suddenly it turns into red color. What happened? You're trying to mess with my portfolio. The thing is, if you actually wanted to exit a position, let's say over here, and you see that the bid is 162 on the live matrix, then that's the issuer's fair price. But sometimes, I always say that you can actually receive bonus profit. You can always exit any positions regardless of the color. Red you can exit, orange you can exit, green you can exit easily because the issuer is going to be there at 162. But sometimes you can receive bonus profits because there are individuals that would queue at say 163, 164, 165, and you'll be able to sell it to them and actually get a better price than what the issuers offer at times. But like I said, success is preparation plus opportunity. You must be prepared, then only you know how to spot opportunities, right? And you know how to use a live matrix, then you'll be able to spot these opportunities. How do I use the last defense now for Hang Seng? So earlier I spoke about the last defense strategy for equity warrants, Malaysian warrants like DNO, M.E.S.T.I, Ta'an, whichever you like, DNEX. But for Hang Seng index warrants, they're slightly different. But what I want to show you is that we've changed our matrix slightly since we spoke last year. And we've gone into this style where we have the upper range and lower range. Meaning, if the underlying HSI futures contracts for that month is somewhere here, let's say it is 21,900, then we know it's going to be somewhere in the middle of 21,843 and 934, right? So the warrants will be quoting at 13 and 13.5 cents. Okay, dokes. Same concept as well. So let's say I foresee that Hang Seng Index futures are going to move up 500 points and I want to plot the TP for my intraday or short-term trading. So I can easily see 500 points up would be about 22, I wrote it above here so I don't forget, 21,900 going up to 22,400. So 22,400 is roughly in between there, right? In between 366 and 446. So I know that the warrant will be roughly 16 cents if I'm trading on that day, not counting for time value decay. So let's say 500 points up. I know that my ROI, my favorite word, is 18.5%. If I look at another warrant, CICC, I do the same thing, 500 points up from 21,900 to about 22,400. I know that's about 25 points. 25% ROI. HSI, what did I say earlier? Pink color, when it's pink over here, pink is for puts. So pink works in the opposite direction. 22,300 coming down from here. Roughly around there, okay? Coming down to about 21,800. That's 500 points. Our matrices show roughly 500 points because we have the upper barrier and the lower barrier now, okay? So let's say 17 to 19.5. This is how you calculate ROI, by the way. You take the new number minus the old number divided by the old number. That's how I remember it in my very useless mind. I'm actually, to be honest, I'm the worst at math in my whole team. Everybody is way smarter than I am. So if you think these numbers are a bit too confusing for you, just try to remember that Isabelle can be so stupid and yet she can figure it out. So you can too. 11 to 12.5. So that means to calculate ROI, new minus old, divide by old. That's how you calculate ROI. So you can see it's quite easy for Hang Seng to move. You're gonna ask me, is it that easy for Hang Seng to move 500 points up or down? And the answer is yes, it is. This was a chart taken from mid-April. So easily, you need to have a basis of technical analysis, of course. But sometimes if you don't have a basis of technical analysis and looking into octopus and choosing a number for you works, then so be it. But for me, I find technical analysis works exceptionally well for Hang Seng Index trading. So this is all I saw. You can see the timestamp over there. This is April. What I noticed was the most basic of technical analysis. Okay, the most basicest of basic technical analysis, which you can actually read on Investopedia even, alright? But you can look through my previous videos. We actually have a checklist of the technical analysis tools that you need. But let's just go through this today. In our next session, I'll bring in Mr. Afnan as well, and he'll talk about technical analysis and how you can learn that. But the most basic of technical analysis, all I saw was price was below MA, price is smaller than MA, right? All these candlesticks are below. Which MA was I using? Was I using a 20-day MA? I think so. This is a moving average line. So if you don't know which trend it is, when the price is below MA moving average, it really means that it is a downtrend, right? If you don't know what trend it is, look at the moving averages. Price is below moving average, downtrend. Price is above moving average, uptrend. Usually. Price is all over the moving average, go and have lunch because it is whipsawing. Second thing I noticed was that there was a really nice channel on the Hang Seng. This is a one-day candlestick, by the way. Really nice trend over here that seems to be following. Hits here once, hits here twice, and it hits there again. So this is just a really easy channel that you're just drawing downwards. And the third thing I realized, second thing, was that 23,000, can you see that? Was a long-term technical support. So if you actually pull this chart back, way back, a year or two, there's a 23,000 over there. So you need to pull the chart back a lot more than what I'm zooming in now. And you can see there's a 23,000 line over there. So right, I would just plot that line over there. I drew these lines myself with my beautiful charting software. And the third one was that I mentioned channel, right? Let me delete these lines so you can actually see what I'm drawing. Right, so we've noticed these three things. So what happened was we already knew there was this channel here. And of course, people always say hindsight 2020, but this one, I can show you how we plotted this line even before it reached that date. So we noticed that here it was trying to use the 23,000 as support. And when this candle broke through, it was something already really interesting, right? So we already know that it's breaking through the 23,000 support line over there. And immediately, let's say even if you are the worst trader in existence, let's say you're the lousiest trader, all right, you take you confirmation until your confirmation, you wait for every like a million confirmations, right? Fantastic, confirmation is your friend. So you didn't trade here, but you waited for it to go to 22,500, which is roughly here. And you bought a put warrant, and you know that here is the support thanks to the blue line. And you exited over here. And you totally missed out when it went all the way down here. You see that wick? Never mind. Because that already is 2,000 points on the Hang Seng Index. So bringing it back, let's zoom out a bit. Earlier, we spoke about how 500 points, right, can get you these returns. 500 points only. But I showed you how easy it was in 2 days. Hang Seng can actually drop 2,000 points. And how simple it was, given the right tools, it is to actually be able to plot and be able to make these returns. Yeah. Next, we're going to cover the M.E.S.T.I strategy, and then I have one more slide, and then I'm going to leave you till next week. So, M.E.S.T.I strategy covers how do you actually choose a structured warrant. So, step number one. Step number one is choosing a great underlying share. You can consider fundamental analysis and technical analysis. They call it FATA. So fundamental analysis is you choose a great stock and you use technical analysis to choose when your entry point is. Your entry price, your take profit price, your stop loss price. Right, I wrote it all there. If you guys forget what I say because you're busy admiring my cool new studio. So, second thing you gotta do is choose a great structured warrant. So earlier we already chose your underlying. Next we choose the structured warrants that we want. How on earth do you choose a good structured warrant when there are hundreds of structured warrants on a single underlying, right? Mesti strategy kind of simplifies that for you. So the Mesti strategy looks at these few things. It says number one, choose a warrant with a live matrix. So far, there are 6 issuers in Malaysia. We've got RHB, Macquarie, M-Bank, CIMB, Maybank, and Kenanga as of April 2022. So if you've got these 6 issuers and warrants on an underlying can be maybe each issuer has 5 warrants on my AG. How do you choose which warrant is best for you? Use the Mesti strategy to choose. Firstly, make sure the issuer has a live matrix. So far, I only know 2 issuers with a live matrix. That means the matrix actually moves through the day. and one issuer with a pricing table that is static. Well, two issuers with a pricing table that's static. So it doesn't really show you once the price moves. Secondly, look at a warrant with high effective gearing, balanced with low tick sensitivity. That means few ticks to flip. Earlier we spoke about ticks to flip. And the fourth, you look at time to expiry. Avoid trading or holding a warrant with less than 1 month to expiry. Let's say a warrant these days has 8 months to expiry. Make sure you plan to exit the position at least before that 1 month, all right? Avoid that final month. And of course, choose a responsible issuer that is lovely, charming, has a Telegram, WhatsApp, email, or phone hotline. So why is it so complicated, Isabelle? Why can't you just tell me, is the warrant good or not? Huh? Just tell me, good or not, end of story. The reason being, each warrant is a different child. So all these different childs have been structured by issuers differently. Exercise price is different, affecting exercise ratio, and all of these things, yeah, they're good to know, and I'll cover them in next week's session with Mr. Johan's webinar. But for you, as a trader, if you want to know how to make money, or whether you want to know how to make money trading structured warrants, or you want a PhD in derivatives, then you decide, all right? But as a trader, I would feel that the most useful thing would be to understand the balance between effective gearing and sensitivity. So effective gearing, the reason I would say you need to balance high effective gearing and low tick sensitivity is this. Let's say a warrant over here, when it's very deep out of the money, you realize that the absolute price is very low, it's very cheap. So warrants over here in this category, they would be at the half cent, 0.005, that kind of price, half cent warrants. And over here, they can be very expensive. Let's say, just for example, maybe a RM1 ringgit 160 warrant. What happens is, when you choose a very, very, very cheap warrant, and this works for Hang Seng as well, it has many ticks. Sometimes a half cent warrant, yes, if it flips one time, it will be 1 cent. Your return would be 100%, which is super sexy, but it takes many ticks to flip, right? Remember the live matrix, the live defense that we showed you just now? It takes a long time to actually get there, and it might not even hit that target price, and then you can't even exit your position. But let's say if the warrant goes on this side, they're very deep in the money, yes, it becomes more sensitive. It might even be 1 tick every single level. It goes from 141, 142, 143, 144, every single level in association to the mother share, to the underlying share. The problem is, I realize a lot of retailers don't like trading very expensive warrants because they say, I'm trying to buy warrants because it's very low in absolute price. Why are you forcing me to buy something that is so expensive? I might as well buy the underlying share. Fair enough. So the sweet spot that you're looking for as a trader is to find something that has high effective gearing and few ticks. And usually it's going to be approaching the at the money session. Okay? And finally, days to maturity. The reason I say avoid it is because time value decay, it falls like a waterfall in the last month. So you don't have to hold a warrant till expiry, and it's perfectly fine to buy a warrant that is out of the money as long as you exit the position before the expiry date and before the last trading date. Last slide. Structured warrants versus company warrants. What is the difference? Very easy. They have different names, done, end of story. I'm just kidding. Structured warrants, they have these naming conventions. They're all C's, AirAsia C, Serba C, but of course we don't have Serba anymore. Ha 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 ha. Top Glove C's, and call warrants on indices such as KLCI, HSI, S&P 500. They are Cs as well. Put warrants are always H. And if you get confused by all of these little letters, it's just because Bursa's naming convention is CA, CB until CZ. Then after that, it goes from 1, 2, 3, 4 until 90. After it goes from C1A, C1B, C1C, like that. And of course, company warrants, they're always Ws. The reason that trading structured warrants and company warrants can be very different is because they are issued by different people, yes? Structured warrants, they are issued by third-party financial entities, like these issuers that I mentioned earlier. And company warrants, they're actually issued by the company themselves. So that means if you have Excel Force or M3 Tech or Sanichi over here, these companies actually issue these warrants themselves to raise capital for their companies. However, structured warrants are actually issued by these issuers for you to be making money off them. So let's say these have different time frames, fine, you can read them yourself, and they have different settlements as well. These you get shares upon expiry, and this you get a transfer now, cash settlement transfer into your e-dividend account. But the main difference is structured warrants. You can only trade them, well, the best way to trade them in my experience is if you use the M.E.S.T.I strategy and live matrix because they have a market maker. And for company warrants, you can consider premiums, discounts, expiry, volume, all of these things because it doesn't have a market maker. And there's nobody to offer liquidity on both sides and control the price, which is why sometimes for structured warrants, you'd always notice that they are 500K on the bid, 500K in the ask, and you're wondering why it's such a nice round number. It's because a market maker exists, this individual. So we'll cover a bit more of market makers, issuers, ingredients of structured warrants, and expiry of equity warrants and Hang Seng Index warrants next week in our upcoming session. But our final giveaway for today is right Q4. Please, if you're gonna answer this for this 100 ringgit Shopee vouchers, which of these is a structured warrant based on the Hang Seng Index? Oh my goodness, so difficult. A. Hang Seng C1U, Hang Seng CAs, HSI WB or HSI CQF. What can the answer be? I've clearly told you the answer over the last few minutes. 5, 4, 3, 2, 1. Right. HSI CQF. Congratulations if you got it right. I'll look through the chats later. I can see all of the chats. Okay, you guys are very fast. Okay. And now for our next giveaway, we've got D-Next CG. Exercise price is 1 ringgit 20 cents and it is currently trading at 102. So exercise price is 120. Currently it is trading below at 102. What does this mean? 5, 4, 3, 2, 1. I know I didn't cover it today, but for those of you who have watched my previous webinars, you would know this answer. If you don't know the answer, don't worry, we'll cover it next week. The answer is B. Q5 is B. That warrant is out of the money because exercise price is the white color pen you're seeing right now, 120. Trading below, say 102, it is out of the money. If it's trading at 120, say D-Next underlying is trading at 120, it is at the money. And if it's trading above, let's say 121, 122, 123, it is in the money. If any of you answered D, that is incorrect. No? And of course, for our FAQs, you can join us at Kenanga's YouTube group. It is not actually Kenanga's YouTube group, it's called Kenanga's group. But it's our Kenanga YouTube where we answered all of these questions earlier today, and by next week, we would have answered all of the questions in red. So if you've ever wondered what are the features, benefits, we've actually through the years, I've actually compiled all these questions: basics, strategies, HSI warrants, live matrix, issuers, expiry. By next week, you would have known the answer to everything in red over there. Yay. And this one's actually no. Oh. The remainder of my slides are mostly about technical analysis. Today's talk isn't about technical analysis, it's about structured warrants, but I just threw the slides in there because I think you guys can benefit a lot from learning how to apply some technical analysis on Hang Seng Index. So I just covered some FIBO, some SNR, support resistance lines, and a bit of Gen M using Malaysian equities, not just Hang Seng Index. And of course, our upcoming webinar next week with Mr. Johan J. Lee. If you remember, he had come on our webinar a few times last year. He successfully plotted the target price of Hang Seng Index to be 23,000, and that was about 2,000 before it actually hit that price. So he actually did manage to give an exceptional target price for Hang Seng Index. And of course, our Garmin giveaways are on our Kenanga Facebook group. Press share once you find this post with the handsome Mr. Kevin Liu and this woman, Isabelle. She's gonna be over there. Press share on the Facebook post and write your 3 key takeaways from today's webinar. I'll be able to see them. We will choose the most constructive, useful, inventive, observant 3 key takeaways, and we will give you 5 Garmin watches, because honestly, I don't know what I'm gonna do with them. I gotta give them away. I've already got a Garmin watch. I don't need 5 more. That's it for us today. See you again next week. It's been a joy. Thank you so much for joining us. And don't forget, Mr. Johan's session, please RSVP on the Zoom link. We've got limited seats, so if you do miss that session, you will have to catch a recording which will come out much later on. Thank you and see you next week.